Kering's cost-cutting strategy, a new era under CEO Luca de Meo. Kering is facing a critical turning point and responding with intensified cost-cutting measures after yet another disappointing quarter. This is a story about survival and transformation in the fiercely competitive luxury market. But here's where it gets controversial. Will slashing costs and closing stores be enough to turn the tide, or is Kering missing a deeper problem? Let's unpack the details. The French luxury powerhouse Kering is accelerating its efforts to reduce spending as it prepares to hand over the reins to a new CEO, Luca de Meo. De Meo has earned a reputation as a so-called cost killer, known for steering struggling companies back to profitability, making his arrival highly anticipated. The company's latest half-year financial report released Tuesday heavily emphasized aggressive expenditure cuts and debt reduction strategies. These include shuttering retail outlets, offloading real estate assets, and trimming the workforce, a clear sign that belt-tightening is Kering's current priority. At the heart of Kering's troubles is Gucci, its flagship brand, which has been bleeding sales. The luxury giant reported a 25% decline in organic sales in the second quarter alone. Many consumers are holding back, waiting for the much-anticipated debut of Gucci's new creative director, Demna, scheduled for September. This relaunch will also feature some innovative see now, buy now products that allow customers to purchase items immediately after a fashion show, breaking with traditional industry patterns. Kering's net profit slumped 46% in the first half of the year, underscoring the daunting challenges awaiting de Meo, who is set to take over as CEO on September 15th. He succeeds François-Henri Pinault, a Python who has led the family-controlled luxury conglomerate since 2005 and overseen multiple major transformations. Though Pinault is stepping down as CEO, he will remain chairman. In reflecting on this difficult period, Pinault remarked in a statement that the first half of 2025 marked a series of significant decisions for Kering, not only with de Meo's appointment, but also with the arrival of new creative directors at Gucci, Balenciaga, and Bottega Veneta. Pinault acknowledged that the current results were far from what the company's potential allows, but expressed confidence that the groundwork laid over the past 2 years has established a robust base for future growth. However, the grim reality means Kering now plans to close more stores than initially intended, a sign of deeper operational retrenchment. Specifically, revenue for the quarter ending June 30 dropped 18% at reported exchange rates to €3.7 billion, which is a 15% decrease on a comparable basis, falling short of market expectations pegged at €3.75 billion. This represented a slight deterioration compared to the first quarter. Armelle Poulou, the group's chief financial officer, revealed that the company now plans to close 80 boutiques in total across 2025, up from the 50 originally projected at the beginning of the year. During the first half of 2025, there were 41 net closures, with Gucci and Kering's other houses segment, primarily Balenciaga and Alexander McQueen, accounting for 18 closures each. Additional outlets were discontinued, and Kering foresees further closures stretching into 2026 and 2027. Most of the group's luxury brands faced organic sales declines in the second quarter, with Saint Laurent down 10% and the other houses segment falling 16%. Bottega Veneta stood out as a modest success, showing a 1% increase, while Kering's eyewear and corporate divisions also enjoyed a 3% growth, countering the broader trend. It's worth noting that Kering's rival, LVMH, also struggled, with its key fashion and leather goods division posting a 9% year-over-year decline in comparable sales during the same quarter, missing consensus estimates as well. But here's the part most people miss. Despite the pressure, Kering has no intention of selling off its weaker brands, distancing itself from rumors swirling around LVMH's reported efforts to divest Marc Jacobs after previously shedding stakes in Off-White and Stella McCartney. Instead, the company is committed to revamping struggling labels like Alexander McQueen, which is currently undergoing restructuring. Jean-Marc Duplay, Kering's deputy CEO responsible for operations and finance, emphasized, "We have a clear strategy for each brand, and we're focused on executing that strategy correctly on a brand-by-brand basis. At this point, we have no plans to divest any of our assets." The luxury sector, however, continues to be buffeted by external forces beyond Kering's control. Trade wars, geopolitical tensions, and volatile financial markets have dampened the global personal luxury goods market, which Bain and Altagamma's latest industry study projects to shrink between 2 and 5% this year. In addition to weak consumer demand in China and unpredictable conditions in the U.S., Kering was hit hard by a sharp plunge in tourism. Directly operated stores saw sales fall 19% in Asia-Pacific and 10% in North America. Somewhat better than earlier quarters, but still troubling. Singles plunged 29% in Japan and 17% in Western Europe, partly due to stronger local currencies discouraging foreign shoppers. On the trade front, Pulu said Kering is preparing for a new tariff agreement announced recently, wherein European Union goods entering the U.S. will face a 15% tax. However, she believes the impact is manageable through strategic price adjustments, highlighting that some brands already raised prices in the second quarter. More price increases might be introduced in the fall, contingent on consumer appetite. Meanwhile, Francesca Bellatini, Kering's deputy CEO focusing on brand development, described the outlook for China as uncertain. Even though high-end segments like fine jewelry and watches show resilience, the overall economy is still hindering consumer confidence, with savings rates remaining elevated. Premium quality products are currently performing better, Bellatini said. "We remain optimistic about China, but predicting when the market will fully rebound is very challenging. Despite the cost reductions across Kering's business, a swift rebound in profits doesn't appear imminent." Recurring operating profit dropped 39% to €969 million in the first half. Although this was slightly better than analysts expected, the recurring operating margin shrank from 17.5% a year ago to 12.8%. Paulu forecasted that the EBIT margin will decline again in the second half, but to a lesser extent than the first half, noting that ongoing weakness in Asia has led to a lowered gross margin forecast, now expected to remain flat instead of improve. On the cost management front, Kering reduced operational expenses by 11% in reported terms during the first 6 months, with fixed costs playing a significant part. Bolu anticipates a mid to high single-digit drop for the full year, prioritizing spending on advertising and promotions to maintain brand visibility and bolster the launches of new collections. Kering's sales decline, Gucci's 25% drop explained. Kering's latest quarterly sales figures have fallen short of expectations, with a notable 25% decline in Gucci's performance. This situation raises significant concerns for the luxury brand's future. On July 29, 2025, Kering, the parent company of Gucci, reported a 15% decrease in its quarterly revenues, which was below the anticipated 13% drop that analysts had forecasted. The total sales for the second quarter amounted to €3.7 billion, approximately $4.3 billion, indicating a substantial decline compared to previous periods. Gucci, which is a major contributor to Kering's profits, recorded sales of €1.46 billion, marking a staggering 25% decrease year-over-year. This downturn is particularly alarming, as Kering, controlled by the wealthy Pinault family, faces mounting pressure from investors to turn around its declining fortunes after 2 consecutive years of falling sales. Additionally, the company has been working to reduce its debt, which stood at €9.5 billion as of June, down from €10.5 billion at the end of the previous year, largely due to the sale of real estate assets. Kering is also planning to streamline its operations by closing up to 80 stores by the end of 2025. In light of these challenges, Kering has appointed Luca de Meo, the former CEO of Renault, as its new chief executive starting in September. De Meo will be tasked with restructuring the company during a time when the luxury sector is experiencing a downturn, influenced by weak demand in China and inflationary pressures affecting consumer spending in other markets. Armelle Poulou, Kering's finance chief, expressed optimism about their collaboration with de Meo, stating, "We have already started working with him, so we can hit the ground running." Moreover, a newly established 15% tariff on all European Union exports to the United States, a crucial market for Kering where over 20% of its sales are generated, poses additional challenges. However, Poulou reassured stakeholders, saying, "The tariff impact is perfectly manageable for us." Kering's various brands, which include Saint Laurent, Bottega Veneta, and Balenciaga, have already implemented price increases globally, particularly in the U.S. Poulou noted that the company is adopting a cautious approach, closely monitoring consumer sentiment. She hinted at the possibility of further price adjustments in the autumn, stating, "There could be a second wave of price adjustments in the autumn." As Kering navigates these turbulent waters, the question remains, can they successfully revitalize their brand and regain investor confidence? What are your thoughts on Kering's strategy moving forward? Do you believe the luxury market will rebound, or are we witnessing a fundamental shift in consumer behavior? Share your opinions in the comments. Gucci sales plunge, Kering's design dilemma. Gucci sales take a tumble, a look at what's behind the curtain. In a surprising turn of events, Gucci, the flagship brand of the Kering Group, has seen its sales plummet by 25% in the second quarter of this year. This significant downturn comes as the brand navigates through its second major design overhaul in just 3 years. But here's where it gets controversial. Is constant change truly what luxury consumers want? Kering SA, the powerhouse behind Gucci, confirmed these figures in a recent statement, noting that this drop was anticipated by market analysts. Despite aligning with predictions, the news has sent ripples through the fashion industry. Overall, Kering's revenues have also fallen by 15%, echoing the challenges faced by Gucci. This pattern of frequent redesigns at Gucci raises a critical question. Are these shifts in design alienating loyal customers? It's a daring strategy in the often tradition-bound world of luxury fashion, where brand identity and consistency are typically revered. And this is the part most people miss. While change can be refreshing, too much of it might lead to uncertainty and discomfort among consumers who cherish familiarity. What do you think? Does the allure of the new outweigh the comfort of the old? Or is Gucci risking too much with its rapid transformations? Dive into the discussion and let us know your thoughts in the comments below.